Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. Going to talk about U.S. consumer and their jobs, the frothy markets, stock market, the gold market, cybersecurities, all that stuff. And at the end, we'll talk about prospects for Europe, another important economy. First, numbers. Bureau of Labor Statistics and a lot of the government agencies that do initial claims, so on and so forth, government shut down, so they're kind of shut down. The data that we're getting is still pretty accurate. It's just getting a little thin, so we don't have a lot of initial jobless claims, but unemployment numbers are good. ISM, which is a Institute of Supply Management for manufacturing and service sectors, their new numbers out, and they're very neutral, not growth or contraction. Interest rates are down a teeny tiny bit, and curiously enough, oil has really been on a roll climbing up, and it still didn't get into 60s, 59 and change, and that's after kind of a nice recovery. But the mortgage market, since we've been lowering rates, adjusted weeks ago and really hasn't moved anywhere. They're not anticipating much in the way of excitement, whether they lower rates or not at the end of October or the end of December, either one. That marketplace is sort of hanging in there, and they have a very fine line between valuations of homes, and when you're lowering interest rates, generally the value of a home goes up. Or lowering their interest rate because the 10-year is what they base all of their decisions on. It might go down, it might not. So, you always want to look, and I recommend you always want to look if you think there's problems in the economy, look at the consumer. The U.S. consumer is the most important economic entity on the planet, and it is 70% of our economy. Well, is the consumer spending money they don't have? Are they building a lot of debt? No. The trend is sideways at best, which suggests, one, they're not overspending. Two, their income, their disposable income is okay. They're keeping up with inflation, and they're not getting carried away putting another bubble on consumer debt. It simply isn't there. And consumer loan growth, are they out buying boats and motorhomes and whatever else that isn't revolving debt like credit card debt? No, the dark line down there says 2025. It's neutral. It's not like frequent other years, but the other years that are on there, people are out spending. No, they're not, which isn't necessarily good, isn't necessarily bad, but it's more good than anything because GDP is up around 3%, and it's going to continue to be high. Spending generally generates biggest part of the numbers in GDP. They're spending just enough. They have just enough income. They're not going overboard. That's not a consumer in crisis. Doesn't need cheaper money to move along. The labor turnover, there's a lot of talk, discussion, pronouncements made that the labor market is slowing. Well, I'll tell you, it really isn't slowing. It's adjusting down where it should be. Turnover is down. New jobs are down because the jobs are pretty much filled. And very quickly, I'll tell you philosophically, that the U.S. isn't like the next 7 economies on Earth, China and Japan and Indonesia and Vietnam, all of those guys. Those guys need to grow. Those guys need to put out more stuff all the time. Granted, a lot of stuff that comes from Asia comes to the U.S. It sits on shelves for a little while until new stuff comes in, and then it goes in the landfill. Well, they have to have that kind of production because they have low profits, especially China has low profits, and they have to turn that stuff over. Shoes, clothing, all that sort of stuff. U.S. is not that kind of economy. We don't have to produce vast quantities of new stuff all the time to be profitable. Our economy is different, and one of the parts of the economy is the labor market. As we're becoming more and more automated and more productive all the time, there is a thing known as the break-even number. And the break-even number, and this is the black line is the smoothed break-even number. Break-even is sort of comparing what new jobs are needed to replace those who are leaving the workforce Remember, we have a lot less immigration, about 800,000 people less immigration, and people not participating in the labor market because they're doing gig jobs or have something else or are already retired. The U.S. economy is definitely moving down to we've got all the jobs filled. Anybody who wants a job, we have it. And we don't need a lot of new jobs. We don't need the froth in the market. What we have is stabilizing in the labor market that doesn't need a lot of help. It's not an area that you need cheaper money, so people and factories are going to go out and hire more people. That's just not the case. It is an issue with the government being shut down at this point. One of the other line items that the administration is looking for is we have to get rid of this probably very excessive number of new federal employees that's been acquired, mostly in the last administration. And there's probably another several thousand permanent departures out of the federal government to go. And it's a pretty safe bet that they will continue that until that gets cleared out. It's not just 4 and 8 offices. It's going to be Treasury. It's going to be everybody. Department of Defense. It's another line item that needs to come down, and that is just going to be happening. The other side of the coin is that people are starting their own businesses, quite successfully starting their own businesses. We've talked about this the last couple of years, the number of new filings, what's known as high-propensity filings, continues to go up. And this isn't gig jobs. This is people going out on their own or with a partner or something like that, and they're doing their own thing. And they're not generally part of the traditional employment numbers because they just pay themselves. They're doing well mostly because in the indicators you want to look at is how the consumer's doing. And the consumer's doing pretty well. They're not suffering. One of the issues is there's really a big thing going in the media right now that tariffs are really hurting the consumer, costing everybody. We're getting hit by, or in this case, this one says surged. If you look right there in the middle, it says this is where the biggest part of the tariff debate started is with Canada and Mexico a little while ago. And some things grown domestically, produced domestically, they're up a little over 2%. I think that's the black line. Things that were imported are up a little more than 3%. I wouldn't call that a surge, but that's kind of where it is. And that increase is part of the inflation cycle, which we're working on, but it isn't slowing or damaging the consumer. There's no evidence of that at all. Right now, it's just debate. Considering how high some of these tariffs are, it's really not showing up in the numbers. And a lot of the people who are being tariffed are eating it. China, Vietnam specifically. The markets, well, I've talked for quite some time that the stock markets, the domestic stock market is overvalued. We had a good day. I shouldn't say good day, but it was a good day as far as not having a bubble in the stock market is concerned. Came down a chunk. It needs to come down a little more. Not that anyone is going to really be abused or suffered on that, but we're working in bubble territory right now, and we need to come back, get back to earnings, get back to, let's see some productivity, let's see some imagination, automation, whatever it is. Get back to gauging and valuing your stock market and somebody's stock on their earnings. Hopefully that will continue to correct. Over the course of time, and most of you know that gold and stocks, and the blue line here is basically global stocks, generally aren't correlated. They move opposite directions. They haven't been almost 2 years now. They've simply been going up. Some of that is there's a lot more money in the system. You remember that $4 trillion we put in for COVID, which is still a good idea, but it's in the system and it's got to go someplace. It's in the pockets of consumers for about 3 months. Then it works through the system, ends up in institutions and banks ultimately, and that needs to be placed. It needs to be invested. So gold and stocks and cybersecurity and a bunch of things are all going up in tandem. That's not a trend that will stay. There are going to have to be some corrections, and there was a big one in cybersecurities here over the weekend, and there will be more. Don't be concerned or worried about the stock market coming down another, let's call it 10%. It's rational, very healthy. A lot of rumors out there about, oh, the dollar. Some people think it's really important that the dollar be the reserve currency. It's not like you have a choice. The dollar is the reserve currency. Everything pins on the dollar. A lot of media and press and politics about, oh, well, Russia's now doing contracts in the yuan, and people trying to switch their currencies. That's fine. It doesn't matter. They have their own reasons, their own restrictions. A lot of them are trying to get around sanctions. The dollar is the ball game as far as currency in the globe. The global currency market, which is still controlled by about 200 people, trades $10 trillion a day. It's a big market. Huge numbers. Well, 90% of them are dollars for a reason. Don't worry about the dollar. And finally, well, Europe is an important, not necessarily an important customer, but an important kind of closely tied economy to the U.S. And the fundamentals are not good. You followed the political issues in France. A lot of political issues. France is absolutely a traditional welfare state. Everybody's on the dole in one form or another. Huge issues on, taking the pension up to age 65 is gigantically important. It is huge. Germany's not far behind. Neither is the UK, who's really not part of this at this point. They don't have active consumers. They have labor who is not working that much, and they are on welfare. And those economies simply aren't growing or prospering or doing well, or right now have a very good outlook. They're going to have to do something fundamental, which they're trying to do in France, which I'll tell you there's very little chance it's going to be successful. Because if they don't want to work and they still get paid anyway, well, they're going to opt to get paid anyway. Okay, well, count on cheaper money here at the end of October. It's okay. As always, send questions along to info@shjwealthadvisors. I'm happy to deal with it. And I'll see you next time.